web conference. They'll walk you through how physical gold and silver work, explain how a gold IRA works, answer your questions, and share the information you need to decide what makes sense for your own financial goals. Whether you're simply curious or seriously exploring your options, it's an opportunity to learn from people who spend every day educating Americans about precious metals and retirement diversification. If you'd like to continue learning, visit juliabuysgold.com or text Julia to 35052 to get Augusta's free guide. After all, the best financial decisions usually begin with learning from trusted experts. Now, back to the episode. I'll feed into gold, oil, your outlook there, because I know, Jim, the last time you and I spoke back in late January, it was before the war had broken out. Gold was already marching toward 5,000. Then I know it's pulled back, but even I'm looking at gold price today, and it's moving higher. It's been on a tear lately again.
Well, I did an analysis, Julie, it's a great question, about 6 weeks ago, and I wrote it up because gold peaked at $5,400 an ounce, depending on what ticker you look at, but say $5,400 an ounce at the end of January. It fell over 20%, a lot more than 20%. And then the talk was, is this the end of the gold bull market? Is this a bubble? Is it heading down? A lot of people say, yeah, it's peaked, it's heading down, et cetera. But I did an analysis based on something that Jim Rickards told me 10 years ago, and which I took his guidance and applied it to the current circumstances to make a forecast of where the bottom would be. And I said two things. I said, this is when gold was still falling. I said the bottom will be at or above 3,600. It could go as low as 3,600. It actually went to 3,900, which is not exactly 36, but same order of magnitude. And I said from there, it's going to bottom and it's going to go a lot higher very quickly. And that's what happened. It bottomed a little higher than what I was estimating, but okay, I was close enough, and it has turned around since then. And you're right, it's up 10% since then. What Jim Rickards told me, he said, this was in 2014, 2015, right in there. But gold had peaked. The big bull market from 1999 to 2011 was over. Gold had peaked at $1,900 an ounce in August 2011, which was a 2,300% increase from the $250 an ounce level in 1999. But when Jim and I spoke, it had come down a lot and was kind of making its way to the, eventually to a new low in December 2015. But he said, Jim, no commodity goes to the moon without a 50% drawdown along the way. And if you don't understand that, or you're not prepared for that, you're in the wrong business. And so I took that to heart, and I said, okay, if you want to do that calculation, you need a base. So I picked the $250 an ounce base from 1999. Went up to 1900, which was August 2011. I took half the difference. I subtracted that from 1900, and I got $1,070 an ounce. Guess where gold bottomed? $1,050 an ounce in December 2015. I used Jim's method, but he was exactly right. And he stuck the landing. It was within $20, But the point is, from 1900 to 1050 in December 2015 was a 50% drawdown, almost exactly, using the 1999 base of $250 an ounce. And that's and then there's another tool in the toolkit I use, which is fractal mathematics. It basically is something called scale invariance, which was all discovered and applied to economic markets by Mandelbrot in the 1960s. So this and later this work has been around. But scale invariance means if I gave you two stock charts, and one of them was a 1-week chart, and the other one was a 10-year chart, but I erased the dates and the index. I just gave you the chart, but they were, authentic. They look the same. meaning the ups and downs and dips and spikes and volatility and peaks and valleys look very much the same at any scale, meaning at any time scale or index scale. And that's what we mean by scale invariance. So taking that, basically using Jim's methodology, applying the idea of scale invariance, I said, okay, let's do the same thing with new inputs and maybe a smaller scale. Okay, because we're from a higher level, see what we get. And that's where I took I used as my base 1800, which gold was not that long ago, like 2 years ago, it was about $1,800 an ounce. And I took the $5,400 peak. I took half the difference from $5,400 to $1,800, divided by 2, subtracted from $5,400. And that's where I got the $3,600. But that was fractal mathematics and Jim Rickards, wisdom, if you will, about commodities prices. So based on all that, I made the call. I was very close, not as close as he was. That's okay. And so it's just going to go up a lot from here. We've hit that bottom and we're heading back up. Not just, yes, you're right, Julie, about the ticker in the past few weeks, but that's just the beginning of a much higher surge. I feel very comfortable with my $10,000 an ounce call, which I made on your show and earlier, but we were not looking at peak gold or a meltdown. We were looking at these kinds of drawdowns that do happen, and now we've hit the bottom and we're going much higher from here.
What do you think explains the move in gold? Does it have to do with geopolitics? Does it have to do with our fiscal picture? Is it inflation? What do you think? What are the forces that are driving it? And what's the narrative that you think is completely wrong out there that you're hearing?
Two really good questions. I'll take them separately. What's driving it? Kind of all of the above, but just to break it down a little bit, the central banks are still net buyers. Russia sold a little bit because they needed the dollars, but on net, central banks are still net buyers. So what that does, that by itself doesn't send gold to the moon, but it does put a floor under the market. Central banks are actually pretty savvy buyers. They, I hate to use cliches, but they buy the dips. They don't overpay, but other forces will drive the price of gold higher. But the central banks kind of keep it from going lower. So that's a nice asymmetric trade. You have, as a speculator, trader, and investor, you have the upside, unlimited upside, but limited downside. Those are my favorite kind of trades. So I would put the central banks at the top of the list. Inflation, for now, is less important than a lot of people think. Gold can be an inflation hedge. It's also a deflation hedge. During the Great Depression, from 1929 to 1940, but you can use different dating methodologies. But during the worst part of the Great Depression, when every price was collapsing, gold went up 75%. It went from $20 an ounce to $35 an ounce. So, but why did that happen? Well, we were on a gold standard, but gold standards change, and FDR raised the dollar price of gold. He didn't do it because he loved gold. In fact, he confiscated all the gold in the country. He did it because he wanted to get the price of everything else up. So a gold spike meant that corn, wheat, oil, mining, agriculture output, everything else went up. And that's what he was aiming for, because he was trying to break the back of deflation. And so what's the quickest way to get inflation? It wasn't money printing. I talked to Ben Bernanke about this, and Bernanke agreed, but it was not money printing. It was devaluing the dollar. See, when you say the dollar price of gold went up, which it did, what's really happening is the dollar's going down. I mean, if you need more dollars to buy your ounce, the dollar's worth less, and that is inflationary. So, the dollar price of gold went up, but what it meant was that they devalued the dollar relative to gold, and that devaluation triggered the inflation or stopped the deflation. So you can see a situation where we're in another disinflationary or deflationary episode today, because the inflation we're seeing